put the spotlight as to what's happening with respect to Suprajit Group. Ajith Kumar Rai, the promoter and chairman of the group, is joining us on the show right now to talk to us about what's happening with the industry. Hi, sir. Morning. Thanks so much for making time for us. Well, the auto industry has been, facing some sort of growth challenges. Do you expect the current weakness to persist in the coming months, or would you call it transient? Would you call it cyclical? And you're expecting the overall sales growth to bounce back sharply?
Yeah, the demand is not that exciting. We just completed the famous festival season. I think the both festivals, Dasara and Diwali sort of fell in more or less in the same month. So October has been a good month, I think. But if you really look at the last 5 months, from April till, or say 7 months till October, or even till November, which is 8 months, there are two segments to it. One is what is the retail sales, and one is what is the sales that the automotive guys are doing to their distribution. If you look at the automotive manufacturers' dispatches to their distributors, it has been reasonably healthy, particularly two-wheelers has been good. Passenger vehicles have been fairly tepid. But what is more important is how is the retail sales. I think the FADA data shows that the retail sales for the first 8 months has been, I think, 7% or so, whereas the automobile majors have shipped nearly 12-13% to the markets, to the distributors. So there's a big delta which is being built up in the marketplace, and that's why there's a lot of discounts being offered, particularly in the passenger vehicle segment. So I would say that there is still a lot of pipeline stock, particularly in the passenger vehicles. I think two-wheelers are slightly better, with the rural demand sort of picking up. So I would say that, the actual business is in single digits, 6-7%.
When it comes to the two-wheeler demand, are you a lag indicator of demand trends, or you're a lead indicator? Because the demand in a sense has been a bit patchy. So when you're dealing with, let's say, your buyers here, OEMs, do they indicate you in advance that how demand would move, or it's right now very fluid?
Amongst the automotive segments, I think two-wheelers are doing pretty well. I think they are in the double digit, at least at the OEM levels. That's a good sign. I think there seems to be some recovery in the rural market, which is a good sign for the two-wheeler industry. So we see that Q3 and Q4 should be reasonable. I think we are, from what I hear from the customers, I think the two-wheeler industry is doing slightly better than the passenger vehicles. So we expect a decent Q3 and Q4.
Right. If you look at the environment, it has been pretty challenging. But despite that, your core margins have remained strong. They've been above 12% in the last quarter. But the pressures on the demand front has not eased at all. So do you believe that these margins will be sustainable in the near future, at least for you?
I think we would be able to, perform the way we have performed in Q1 and Q2. I don't think there will be any down trend at all. We expect growth to be quite good. We expect the margins to hold. Particularly the domestic businesses have been pretty strong. And I think even our global controls division has been doing a steady business despite very difficult market conditions. And Phoenix Lamps division has done very well. So both domestic cable division and Phoenix Lamps division are doing very well. And electronics divisions are growing well. Margins are something that we need to work still more on. But on a consolidated basis, we are quite comfortable that, that 11-12% consolidated EBITDA margin, and on a standalone basis, around 15% EBITDA margins are a sustainable margins for us as we speak.
Okay, so that's a sustainable margin picture, but international, sales have been a large part of your growth drivers as well. However, off late, the commentary regarding Europe, etc., hasn't been that strong. What would you call out in terms of how the international business is right now, and what the expectations should be from international geographies?
The geopolitical uncertainties are the top on the agenda in terms of uncertainties. There are two wars around. And then also there are, leadership changes in US, and challenges in Germany. European markets are down, US markets are down, not only in automotive, but also in the non-automotive space. So if you really look at the industry as such, I think the global industry is really struggling with slightly negative growth only. There is no growth in the global market. Against that backdrop, I think what is happening with us is that we have been winning new contracts. So we have been maintaining at least a stable front. So there may not be a great growth, but we are at least not degrowing. And we are able to, at least in the controls division in the first 2 quarters, we have been able to get a decent margin, a stable margin, which is very important. I think it is important to make sure that the margins remain stable and the cash flows are good. So that has been the focus for us. But I feel that in the balance 2 quarters, that is the next quarter, I don't see the situation really changing in the global markets. We need to have some settling of the geopolitical situation and also the political risk of tariffs, etc., particularly with the new president coming into US. We are carefully watching what are the moves and accordingly to plan our next strategy.
Despite some challenges in Q2, you maintain a positive outlook for double-digit growth in your SCD, which is single component division for FY25. What gives you confidence of achieving these targets?
Okay, controls division, the reason is simple. I think, we have the best global manufacturing footprint. We have the best global engineering and business development footprint. With that footprint, we have been able to offer to customers both onshoring, close shoring, and low-cost options for their projects. So we are probably the only cable company in the world who has got such a footprint. And that gives us a big advantage with the customers. So we have been winning quite a few significant large contracts with these, geographical footprint. And that is where we are confident that we will have continued to have a growth in a market where there is no growth, when a market where there is more consolidation is happening. So going forward, we see a good growth in the controls division. We also see that the margins, of course, the SCS transaction apart, we expect the margins to be consolidating at 8%, which is a global benchmark of, margins for international component business, and probably do even better with a year or so down the line.
Point taken. Mr. Rai, like the way we spoke about these various challenges that are at play when you talk with the sector, given all of that, do you still stand by your guidance for the year? And also, if you could help us understand any expectations that you have actually penciled in when you talk about order book additions in the coming quarters?
I think in automotive, order book is more a number on the paper. Although we have it, we don't really talk about it. But all I want to say is that we have given a guidance that despite these difficult markets on a consolidated basis, we will grow double digit, and that the margins between 11-12% is possible on a consolidated basis, and on a standalone basis, maybe 15% or so. I think that is the guidance we have given. And we still stand by the guidance despite further deterioration in the global scene. We expect that guidance to hold for this year and, as well as for the coming year.
Okay, on that note, we let you go. Thanks so much for making time and speaking with us.
If you like this video, then like, share and subscribe to ET Now.